So today's video, I'm going to actually do a deep dive into how insurance agent commission and earnings are paid. If you are a new agent or considering to get into the insurance sales business, it's imperative you understand exactly how you are going to get compensated. Because the truth is there's a lot of nebulousness, a lot of confusion around insurance agent commission and pay. So I wanted to take some time here to explain exactly what you can expect no matter where you go and no matter what products you sell. My name is David Duford, owner of Duford Insurance Group, where I train and recruit agents nationally to sell things like final expense Medicare or annuities, both over the phone and face-to-face. So let's talk commissions. Look, we're all into this business, or at least interested, because of the wonderful income claims that we hear from others. Some true, some not so true. But there seems to be an element of desire to make a great income in this business simply because of its outstanding opportunities. Unfortunately, you as a new agent are coming in under one particular auspice, and that is you're ignorant. And I don't mean that rudely. It's just the truth, right? You probably are attracted to this business from someone else. They told you about it. You started doing your research. And if you're into the typical insurance MLM pipeline, you've already seen 1,000 Ferraris and stacks of cash and more Kool-Aid than you could ever possibly imagine. So things tend to get a little bit confusing about what you actually will earn when you sell insurance. So what I'm going to do is go over a couple of main points here when it comes to how pay works. Specifically, we're going to talk about how commission versus salary works, if you're paid a salary, and how commission works. And we're going to break down the fine points of commission, not just talk about the percentage commission, but a lot of other points that very few trainers and recruiters actually talk about. And then I'm going to give you kind of like my wrap-up opinions on everything. So first of all, are agents paid by commission or are they paid by salary? Well, I'll tell you about 80 to 90% of the opportunities out there are going to be what we call straight commission. You don't make money unless you make a sale. So if you're looking for a salaried position in insurance sales, the likelihood is small. It's not impossible, but it's fairly small that you're going to find one that's going to provide a guaranteed earnings. There are some organizations out there, and this does change from year to year, so it's not exactly accurate at all times, that will pay a salary for a set period of time before turning you over entirely into 100% straight commission. So maybe they have a build-up period where you're paid a stipend every a week of X amount of dollars for 12 weeks, and then by the end of that, you're expected to be completely on your own. So the thing is, come into this expecting a straight commission, and you really should want that anyway. Sales, as always, is a performance activity. The person who sells the most should be paid the most, and those who don't sell much of anything shouldn't be paid much of anything. So it's the law of the land. It's survival of the fittest, and to the victor goes the spoils. So you should want to come into this with your aspirations to sell a lot of insurance and likewise make a lot of commission from it. But here's the thing, guys. When we're looking at a commission-based setup for insurance sales, it is not all the same. In fact, how you're shown commission will vary wildly. Now, in some respects, it's because of the value proposition that the agency provides. Maybe they provide you free leads. Maybe their brand name is so strong that they feel like you having this brand name earns you business where another agent wouldn't. There's a lot of ways to try to justify a value proposition, and your insurance commission should reflect that. And to what degree you believe in reflecting that is kind of the rub here. So, but you can have them vary wildly. For example, in my agency, the way I set mine up is that I want a business-minded, entrepreneurial type of agent join my agency. So my commissions tend to be very high, but in exchange, I'm not babysitting my agents. I provide great training, great resources, access to me when needed, but I'm not calling my agents at 7 in the morning to demand them to show up for another Kool-Aid rah-rah call when they could be going to write business or doing whatever they want. Because the way I look at it is they run their own business. So not everybody thinks that way, and it's just going to depend. There are organizations out there that are more multi-level marketing oriented. Their whole system is built on a pyramid, not an illegal pyramid, but just structurally speaking, there's a deep organization where there's a lot of downlines that have downlines, and that continues on. And agents are sold the dream without much attention paid to the actual commission. So commission levels typically with insurance MLMs are much lower than what you would find with a training-oriented organization built on trying to train producers to sell versus recruit producers to recruit. Don't like that personally, but that's how some of them do. How wide can the commissions range? There's one particular gentleman that runs a well-known YouTube channel that has 1 million plus subscribers that also runs a insurance MLM. I would argue it's an MLM. He starts agents off at like 25 to 30% commission. There's another one that starts with a P and ends with America, and they start their agents off at 25% commission. But then there's other organizations like mine where a new insurance agent for something like final expense would be at 100%, 110%, even 120% and beyond. So it just, again, it varies wildly. You've got to look at what they're offering you and decide for yourself if the offer, if the juice, as I like to say, is worth the squeeze. So what should you be looking for on commissions? So I'm going to kind of give you some ranges here. I think that are, I wouldn't say these are all good ranges, but these are kind of where a lot of the percentage ranges are for these particular products. What you don't want to be what you don't want to do is get into an organization where they show you all the blue sky and the hype, but downplay the commissions. So you kind of want just a bearing of what you should at least look for. For me, in the final expense arena, if you're going to be in final expense, you really need to be looking, if you got to pay for your own leads, you've got to be self-responsible and go sell, and it's all producer-oriented. Really anything 90% or greater is okay to start with. I'd want some evidence of how to get higher as I advanced. Albeit though, I think you should really be higher than 90%. It's like a bare minimum for me personally. Annuities, again, depends. A lot of people are stiffed on annuities tremendously and they don't even know it. I would want my agents who are new to not have to have any lower than a 4, maybe even 5% commission on their annuities if they're self-generating their own leads or buying their own leads is what we teach. Medicare Advantage pretty much is paid the same throughout. You want to make sure that you own your book of business, ideally, and you should get renewals of about $270 a year starting in 2021. Medicare supplements, really nothing less than, for me as for an independent agent, 18% plus, preferably in the 20% range, based off of annual premium. We'll talk about what these percentages mean more in a moment. Mortgage protection, kind of like final expense, anything below 90%, with the amount of money you have to invest in your own leads, not a good deal. And then fully underwritten is going to be a little bit lower. It can be 60 to 80% I'm acceptable of. It just depends on the product, depends on a lot of factors, but somewhere in that range is not far from the norm. Now let's talk about the fine print, because it's one thing to talk about, yes, you're paid on a straight commission, but there's a lot of these unknown variables that you new agents out there just don't know about. And you need to also factor these in and to achieve a better understanding of how the compensation truly works. So I've got a litany of different points here. None of these are in any particular order. I just thought of it as I wrote down my notes. And so I want to make sure to cover all these. So the first one is advancing. So, let me back up and explain something on percentage of annual commission. So I mentioned this, I want to make sure to cover this. With all of these carriers that we mentioned, all the products we mentioned, when I say something like 80%, 90%, 100% commission, what does that mean? 100% of what? That's exactly what you should be asking. So in most cases, with most companies and agencies, that 100% is a function of what the annual premium is for a policy. So let's say an annual premium for a final expense policy was $1,000. I'm at a commission level of 100%. 100% times the annual premium of $1,000 means my first year commission in dollars is $1,000. Does that make sense? Hope it does. So that's what we base our actual payout on. This may answer the question, how is it possible to get over 100% commission? Well, because simply these insurance companies allow a payout greater than the premiums collected. We have experienced agents in my organization with some companies that are at 120%. So if they had that same case, $1,000 in annual premium, and I had them at 120% commission on that particular carrier, they're getting paid $1,200. even though the carrier takes $1,000 in. Now, why would they want to do that? Simply because they take $1,000 in premium and they estimate it, they're going to take it for many, many years on end. So they're going to win in the long run, take a little loss on the first year to get the business, but make it up over the long run. That's their strategy. And if it was problematic, they wouldn't offer it. So it definitely works. And that's how you get paid more than the premiums come in. And it's totally legitimate and normal. So now that we know how the percentage of the commission is based off of, let's talk about some of the particulars. So first of all is advancing. Advancing is the money you get up front in lieu of successfully collecting premiums later. To put it in other words, an advance is a loan. When you write a policy, that policy is a piece of collateral. We expect a high percentage chance of that policy to continue paying premiums after it's bought. So the company is okay with extending you a loan or advance based off of a percentage of that total first year commission dollar. So in most cases, and I'm going to give you an example in numerical terms, your advances are 75%, not always, but sometimes with your major carriers. So let's say in that same case, at 100% commission with a $1,000 annual premium, 100% times 1,000, you get paid $1,000 first year commission. Well, if you're only advanced 75% of 1,000, that means you get up front, post-sale, $750. Does that make sense? So what about that $250? Well, that is paid in months 10, 11, and 12 of the policy. Remember, if you think about this in monthly terms, 75% of 12 months is 9 months, right? So you get paid 9 months worth of your 12 months commission. So there's 3 months remaining, right? So it's basically that $250 is split up into equal thirds, paid in month 10, month 11, and then month 12. And so you will get your full commission, but you won't get that back 25% until each month the premium is successfully collected. And then after it's collected, you earn that portion that is due to you. Does that make sense? So here's the thing. Advancing can alter and change. It usually doesn't go ever above 75%. Some companies pay 50%, a lot of guaranteed issue carriers do. Some of them will also pay as earned commission. As earned commission is the money that's paid out after each premium is collected on an annual premium basis divided by 12. So it's 100% times 1,000 equals 1,000 AP divided by 12 is whatever that 83 and 33 cents or something, whatever it is. That's what's going to be payable to you in commission every single month, okay? As the premium is collected, as it's earned, right? Because an advance isn't earned money, it's loan money, right? If you think about it that way. It's here's the money, assuming this stays on the books. But as you collect the premium, that portion of advance is earned. Hopefully all of this is making sense and you guys aren't like, glossy-eyed over. So we get how advancing works. Pretty simple. Hopefully we understand. Advancing is really the most important aspect. Well, commission is important, but advancing is too, because this is what dictates cash flow. Yes, we make $1,000 over the course of a year, but if I only get 1 month of that up front because I got paid as earned, and that's how all of my commissions are, I'm in trouble because I'm not going to be able to cash flow sufficiently enough to cover my expenses, my final expense leads, let's say, in this particular example. So we do, in most cases, want advancing, and preferentially most people choose the carriers that advance the most so they can stay cash flow positive. In this business, for sure, insurance sales, cash flow is king, especially if you're using some system that you have to pay for leads. Some other points sometimes that aren't really considered are policy fees. So policy fees are additional fees put into that $1,000 annual premium that hike up the price and make the business more profitable to the insurance company. However, some companies do not pay on the policy fee. So in the example I gave you, the 1,000 AP at 100% commission, I made $1,000 first year commission, right? Well, what if that assumes the policy fee is commissionable? So it's a 1,000 AP, but the $40, let's say, let's call it the policy fee is $40, is included in that 1,000. So it's a total 1,000. But if we extract the 40, our actual commissionable amount it's based on is 1,000 minus 40. So that's $960. So in this case, I'm not paid $1,000 for the first year commission. I'm actually paid $960. Does that make sense? Now, why do we care about that? Why does that matter? Because it's the old death by 1,000 paper cuts thing, right? So if I write 100 policies with a company that doesn't pay on policy fee, and I'm losing $40 in this case on every sale. $40 times 100 is $4,000 in commission. That adds up to a lot of money over time, exponentially if you say put it into a mutual fund that earned whatever the stock market did. So these are little ways to reduce your total earnings amount. And I tend to recommend agents stay away from those companies that don't pay you on policy fee. So be aware of that. Advance caps. So some companies will actually cap your advance. Actually, all of them do, but some of them have really low advance caps. Most companies are going to cap your advances around $2,000. And that makes sense because if you write some huge deal and it lapses after a month and they change your mind, you owe a hell of a lot of money back to the company. So this is kind of a risk exposure reduction strategy. But so expect that, and you won't really ever hit the 2,000 plus range that often. But where it could impact you the most are in those carriers that have advanced caps at say 1,000 or 500 or 600, like a couple of guaranteed issue carriers that I'm thinking about. So that will affect your cash flow. And maybe you need to make more 1 month because money's tight. Perhaps you'd switch gears and write another carrier that doesn't have an advance cap. So make sure you understand your carriers and which ones have advance caps. Early death provisions. This is more of a chargeback consideration. Typically with most carriers, and it's going to vary by carrier, if your client dies within the first year, whether it's contestable or not, meaning whether it should legitimately, the claim should be paid out, or if not because they misrepresented taking the plan out, most of the time you have to pay back your full advance, even if you successfully collected the premiums and got even past the advance. So just keep that in mind. It's very rare that this happens, but it is something that you will have a full chargeback for. Vesting, non-vested. So quick story from a company you all know of, named after an American president. This particular agent I talked to many years ago told me that his regional director fired him and terminated his contract 2 days before his 2-year vesting provision was up. And at risk was about $30,000 in first-year commission and renewal income. You see, in his contract, it stipulated that if you were terminated for any cause, whether it was for fraud or because the agency owner didn't like you anymore, that commission became the property of the uplines. And they had bad blood. The guy termed him about 2 days out. And lo and behold, he had to be notified before he received it. So it actually turned out he got paid. But the point is that how you're vested affects how your compensation is. So whenever you're looking at an insurance company, this isn't exactly directly related to what you get paid, but it's how you continue to get paid if your relationship with the agency changes. You want to make sure you're 100% vested first day from the first day. Because if things change, you shift gears, go another direction, or the promises they gave you didn't pan out, you want to make sure that the business that you wrote stays yours. And meaning when I say stays yours is that you continue to get paid on it. Because a lot of these organizations secretly put in these vesting provisions that prevent that from happening. So keep that in mind. You want to be 100% vested from the first day. Interest on advance. Some of these carriers out there, I don't know really which ones do this. I don't think it's a lot of them. Is they charge you for the advance like 1%, and it lowers your total compensation down by a good 10 points. So just check out as you look at your carriers. Keep that in mind. I mean, you can have a significant reduction in your earnings because you're getting an advance and they're charging you interest and you don't know about it. And then last factor to consider about how you get paid is when you get an advance, when is it timed? There are usually two different ways you can get your advance received. It's either on issue, which is a couple of days after the policy is approved, or after the first draft is cleared. That's important because in our business, we usually don't get paid until, we get paid up front, but if you get paid on first draft, you have to wait until the client's first premium goes through because, especially in something like final expense, we don't take money up front. It starts usually when their Social Security check comes in next, which can be weeks at times. So that can delay the speed at which you get your cash advance. So also keep that in mind. Most agents understandably want money fast, so they choose a carrier that pays on issue instead of on first draft as much as possible. So we covered a lot of ground here, guys. I hope you got some pointers on how all this works. Compensation really is important, and it's not something that is clean cut. It is legitimately something that a lot of agencies do not discuss openly with their agents. They take your ignorance for granted, and then shove a contract in your face and say, don't you want to join the best agency on the face of the planet? Sign right here. Don't think for yourself. And then lo and behold, 90% plus of agents fail out. And one of the major reasons why we did a survey on this is they picked the wrong agency, okay? So that's really why I'm putting this together. I want you to understand, as someone who has necessarily no interest in recruiting you, I mean, maybe I do, but I'm not connected with you directly. I have nothing to try to, promote or hide from you. But you need to know these facts. You need to know if this is the right business for you and how you get paid and how Mr. Recruiting Agency guy says what he says actually pans out to reality. And again, the more information, the more power you have, guys, when it comes to stuff like this, especially getting into this business, the more likely you're going to avoid making a bad decision on joining a particular agency again. I remember when I first started, kind of related, I almost signed a paper that basically paid the agency above me my commissions where they would be responsible for paying. And because they're honest people, they said, oh, please don't sign that. You want to get paid directly from the company. So, that's what I'm trying to do here. Whether you work with me or not is not the point. But we need more knowledge in this business so the failure rates can go down, because there's a ton of people that need our help. This still is a great business to be in with a lot of income earning potential. And not only that, but freedom and ability to run a life of your choosing, and in a way that you will feel good about. Helping people and making good money, good mix, I would say. I hope you enjoyed this video, got some value out of it. If you have any comments, questions, or critiques, please leave them below. If you're interested in joining my agency, there's somewhere a link up here and definitely below. Click on that to learn more about how things work. If I can help with anything, please reach out anytime. My name is David DeFord of DeFord Insurance Group. We'll see you next time. Bye.